What's up, YouTube? Today in this video, we're going to be talking about all things options. It's unlikely we're going to be able to turn you from a novice to an expert options person within one video, but what I would like to accomplish in this video is be able to arm you with the knowledge so you then can go on further research to expand on what you've learned today, or know that maybe after this video, you shouldn't be doing anything in options, and next time your friend tells you, oh, buy a bunch of calls on XYZ stock expiring next week, maybe you shouldn't touch anything because maybe you will go to zero. So that is what I'd like to accomplish in this video. Options is very luring because people talk about the huge gains that you can make in options. Well, that's because of the huge amount of leverage. Well, what are options first? Options give you the right to either buy or sell something in the future. There are two options. In this case, we're talking about stocks, right? So there are call options and put options. Calls give you the right to buy a stock in the future. Puts give you the right to sell a stock in the future. If you buy a call or put, that's what we're talking about. You can also sell a call or put, meaning you're selling that right to somebody else to either buy or sell a stock in the future. And when you're selling an option to somebody, you're collecting the premium. So when you buy an option, you are paying a premium. Think of it kind of like an insurance premium that gives you the right to do something in the future. If you're selling the option, you're then being the insurance company. You're collecting that premium and you're giving the right to someone else to do that in the future. Now, you might hear about things like butterflies, jelly rolls, box spreads, iron condors. All of those are option strategies, which are combinations of calls, puts, and the stock. Now, there's a lot of different combinations that give a lot of different strategies. We're not going to be talking about that in this video because what I really want you to understand is just how options themselves work. So how do options work? Enter the Black-Scholes formula. So in the 1970s, there was a formula that basically quantified what the price of an option should be. Because if you think about that, that's not a very easy thing to intuitively think about. What should something be worth that has some future value on an uncertain, unknown outcome? Well, there's a lot of unknowns there. Well, that's where you have a lot of calculus. And calculus is basically the study of infinity. So if you look at like a circle, for example, there are how many sides? Well, think of like a polygon, a hexagon, and then you get more and more sides. It's basically infinite sides. Well, how do you quantify that? The ancients had a really tough time. Enter calculus. Well, that's an aside. We're also not going to get into dissecting the Black-Scholes formula in this video. That area of finance is what we call quantitative finance. So there's a whole area of finance that's basically devoted to solving really complicated calculus, math problems, and that is quantitative finance. There's also deviations or variants of the Black-Scholes formula, like for example, there's the Heston model and so on and so forth. Now, that's what's interesting is we can actually figure out a general idea about options without having to understand all the underlying mechanics of the math. These formulas then have created what's called Greeks. Ta-da! So the Greeks are basically, think of them as like sides of a Rubik's Cube. So the really important ones that we're going to focus in on this video are delta, gamma, theta, vega, and rho. There are other Greeks which are called shadow Greeks, but those are basically, if we had a Rubik's Cube, think of just adding more sides to the Rubik's Cube. So like making a tetrahexagon or something like that. So that is basically what the shadow Greeks are. It's just getting more fine precision. We're not going to focus in on that. So the first one is delta. Delta measures the sensitivity of the option price in relation to the stock price movement. So if you have a option on, let's say Microsoft goes up $1 and you have a delta of 0.5 and you own a call option, that means your call option has gone up 50 cents. So that's what delta is. Gamma is the second order effect of that, measuring the sensitivity as that keeps moving up. So from $100 to $101 to $102, let's say your delta goes from 50 cents to 55 cents to 60 cents. Well, it's not exactly linear. So how do we know how much that extra movement is? That's gamma. So let's say you had a delta of 0.5 and a gamma of 0.1. That means that the stock price moved up $1 and you owned a call option. Your options contract has gone up 0.6 or 60 cents. Theta. Well, we know options contracts are for a fixed time period, right? You have an option to either buy or sell a stock in the future, but it's not indefinite. It could be a week, it could be several weeks, it could be several years. But time is ticking. Well, that is where theta comes in. And if you own an option, we call that theta decay. So usually that's negative. So over time, your option is dropping in value, because if you had the right for something to do something in the future and you could do it at any time, and you had a long period of time you could do that for, that's more valuable than if somebody said, hey, you can only do something in the future, but I'm only going to give you a window of a week, right? So it becomes less valuable. So theta decay. Vega. Vega measures the price movement of an option in relation to volatility. This is usually the one that's really, really hard for people to wrap their heads around. So if the implied volatility of a call option, let's say, is 20% and the Vega is 0.2 and implied volatility goes to 21%, your call option has gone up 20 cents. Now, this is where you also find people that have the stock price move in their favor, but then they actually lose money on options because they don't understand volatility. Let's say you bought a call option that had an implied volatility of 70%. It's like super, super, super high. And the stock went up in value, meaning, your delta and gamma, hey, that's positive, it's moving in your favor. But let's say the implied volatility went all the way down to 15%. Well, that sucked out that implied volatility, and you're now losing money on the volatility side. So you're having these countering forces that are happening. Another really important distinction to make here is implied volatility versus historical volatility. So I keep saying the word implied. Implied volatility is based on the formula that spits out with the Greeks and saying, okay, implied volatility, typically in Black-Scholes formula. And it's implying what the riskiness or the movement of the stock prices is going to be in the future. So it's this circular reference that's happening. Historical volatility is a totally different thing. Historical volatility can be measured exactly because it's looking at the data points of the history and then figuring out the standard deviation. So if the stock price moved all these different, prices over the last year, you can calculate historical volatility. Implied volatility, you're projecting. It's an estimate. We don't know for certain. And so that's where implied volatility can also differ depending on the calculation that's used. Last one is rho. Rho is the sensitivity to interest rates. Now, interest rates have been pretty low for quite some time, so a lot of people have almost disregarded rho and say, oh, rho doesn't even matter. But rho also comes into existence because you have alternatives in finance and there's arbitrage theory, and that's why rho, you should have some implied interest rate, or and that's also where dividends come in, is the connection to this. So rho is sensitivity to interest rates. So if interest rates went up 1% and you had a rho of 0.2, you would go up 20 cents, and conversely, right? So that's rho. Now, depending on whatever brokerage platform you're using, these Greeks can also be calculated differently based on different formulas, different assumptions. So really important to understand that they will be different. But what I do hope that you gained watching this video is a general understanding of how the options mechanics are working, and understanding that there are these, different sides basically to the cube, and they are not static, they are dynamic, right? So they are dynamic. As you get closer, right, like theta speeds up. You have more theta decay as you get closer to expiration versus having a longer expiration. The same thing with, delta. The delta is going to change depending on how close or far you are at expiration, the sensitivity to that. Also, if the option is really far from expiration, of being in the money, out of the money. So that is all going to have an effect, and that's where you have these second order Greeks that come in. But those are really measuring real precision that most people don't get into. But these building blocks will give you a great intuition of understanding the overall mechanics of options.